All right. Well, we are right at 7 o'clock here. We'll go ahead and get started. Joe, thanks for hopping on today. I know we had, kind of done our weekly market outlook on Tuesday when things opened back up, and kind of interesting. We recorded that about, I don't know, hour before markets opened, and
Yeah.
started out kind of pretty ugly there. You want to maybe give a little bit of a recap on what you saw there and kind of how this week has progressed since then?
Well, I guess early in the week we saw what I would call like a broad-based commodity liquidation, and it wasn't just confined to corn, soybeans, and wheat. I mean, it was a whole bunch of stuff. It was the energy markets backing off. It was a lot of soft commodities. It was precious metals. It was base metals. It was almost everything. And I think a little bit of it was weather. Some places in the Corn Belt have caught some rains, and the forecasts don't look overly threatening to me. But we saw a nice bounce back today, and we just opened here as we're speaking, and we're trading a little bit higher. So a little bit of a recovery. That could have been some sort of short-term low. I don't know if this is going to be a normal summer, seasonally speaking. If it was a normal year, July and August are usually not like really good years for the row crop markets, but the crops are late. There's still time for some sort of weather issue or crop scare event. I wouldn't rule that out necessarily. So there's been quite a bit of excitement here these first 3 days of the week, I guess.
Mm-hmm. I know you do a lot of work, like when you post your daily newsletters, pushing out some of the precipitation maps. How much of that do you think plays into the trading, especially this time of year, from weather? How much weight does that carry, and what should the farmer be thinking about when they see that sort of stuff on either actual precip or projected precip?
Well, in a normal year, and I don't think this is a normal year, but in a normal year, I mean, weather is like the end all be all of the markets this time of year. I mean, once you get into mid-June, first week of July, this time frame, very specifically this time frame that we're in right now, I mean, weather's usually like the deal.
Mm-hmm.
But in this sort of year, we've got all this other stuff going on. I mean, we've got just general inflation, general concern regarding the economy, recession concerns. I mean, the Fed hiking interest rates, the stock market's down hard. I mean, there's just so many different things going on that could influence the movement of money in the markets. And I think that's what we've seen like this last, this $1.25 down in corn, this big move down in soybeans, this huge move down in wheat. You've just seen a lot of speculative money come out of the markets. And I don't think that is all due to weather. And I can't tell you with any degree of certainty why any big fund or whoever does what they do. But I would venture to say, if I had to guess, I mean, I don't think this is all weather. I don't think this is all a weather sell-off. I think there's something here surrounding the just general kind of risk-off environment. Maybe people think the inflation trade's over. Maybe that's coming to an end. Maybe people are worried about recession. I've talked at length about how commodities don't act well in recessions, especially when they're starting at higher prices. So I think there's a lot of other things going on here. So, I mean, usually, yeah, it'd be all weather, and weather matters this year, but maybe to a slightly lesser degree than it does in, what I would call a normal year.
Mm-hmm. So for maybe just a more or basic understanding, looking at the involvement, when you talk on, spec traders, those who are speculative, and the major swings that they can kind of inflict or promote within the commodity trading, especially what we've seen over the last 2 years. Why, what's the overarching theme on maybe why they're making some of these moves? What are they looking at here?
I think there was two this year. I think generalized inflation was part of it. And then I think money came into commodities as an inflation hedge, maybe late last year, early into this year, maybe even prior to that. And then when Russia invaded Ukraine, it really accelerated, especially in the grain markets, the corn market and the wheat market in particular. And now, if you would have bought wheat, after the invasion, you're underwater, I think, on that position overall. So it's gone back the other way really quickly, I think. And I don't know if that's just because the market couldn't hold up, or maybe fundamentally we were just overvalued. I mean, I don't think necessarily wheat, as an example, ever had any business trading $13 a bushel, but we're getting back to some prices. Ideally we'll find some footing here will stimulate some better demand. We'll see what kind of demand emerges at these lower prices. We haven't been here very long, so it's going to be tough. It's not going to be tough, but it's going to take a little while to figure out what sort of demand increase, if any, we can expect now that we've got some lower board prices.
Mm-hmm. To your point on Russia and Ukraine, how much of that is still built into the market right now? Does any news out of there, good or bad, have a major play at this point? And before I let you answer that question, I'm going to refer to your morning audio that you kicked out today, or I think it was today, and you were talking about the fact that, if they get half of their export out from what they have in the past, it's going to be pretty phenomenal feat. So, what's news out of Russia and Ukraine? How's that playing into today's market?
I feel like as a headline, how the headlines move the markets and what it actually means in terms of supply and demand, I think are two different things. As a headline, that story has become stale. It's just not a headline that I don't think people are trading like on a day-to-day basis anymore, like they were back in maybe March or April. It's just kind of become a stale story. Like this war is going to go on for a long time, the way that it seems. It's probably inevitable that Russia takes over at least that eastern part of Ukraine, and that happens at some point in time would be my guess. In terms of supply and demand, I mean, yeah, the estimates out there right now are that they might export, half of the wheat that they would export in a normal year, maybe less than half the corn. I mean, that matters. It definitely does matter in terms of, export demand and that sort of stuff. It matters, and it's overall supportive. I just don't think that headlines out of Russia, Ukraine move the market like they did a couple of months ago. And if you were to see some, say, drastic like material shift in what's going on over there, or in the general narrative, then yeah, that's a market mover again. But for the moment, it's just kind of staled, I think, in regard to a headline and a story that people buy or sell, based off of the daily stuff out there.
Mm-hmm. Anything that I haven't asked you about so far before we kind of jump into the next portion here? Markets this week, as we, of course, we're moving into the weekend here, looking at second week of July already. Anything else that we maybe haven't covered that would be beneficial to the folks hopping on tonight?
I would really just emphasize the point, and I already discussed it, but commodity markets don't like recessions. They don't like downturns in economic activity. I've talked about this a lot, and I can't emphasize it enough. We'd all love to think that every single tick in the corn market and in the soybean market is driven simply by supply and demand. And I don't know that that's the case right now, or ever, but right now in particular, because of the fears out there regarding recession and a downturn in economic activity. It's pretty much a rule across the board when you go through past recessions. There's a couple exceptions, but commodity markets don't perform well during recessions, and that goes for everything from crude oil to corn to soybeans to, I mean, you name it. I can't emphasize that enough. I know that weather matters, and you guys are all going to hear more and more from everybody about weather and yield prospects and USDA reports, and that stuff's all relevant. It always is, weather and the yield number on the national corn balance sheet. I mean, that's always kind of like the biggest swing item, but this other stuff does have an impact. I think maybe more so in a year like this than in any of the other years we've seen as of late, really dating back to like a 2008 type scenario.
If you're a subscriber to Joe's content, his subscriber only content on, I think it's June 23rd, you posted that video on recession. I watched that again in preparation for tonight. And I kind of laughed out loud when I heard you say, soybeans hate recessions. And when you take that out of the context, it's pretty dramatic. But I think what's interesting when we look at what happened this week, and this will help segue into diving into the budget portion, what you all are seeing on your screen. And just to verify, Joe, you're able to see the sheet I have up here. Yes. Okay. So what you all are seeing on the screen is essentially looking at projected market prices and also projected expenses as we move from 2022 into 2023. What you see on the screen in front of you is a composite of 15, 20 growers Chris and I reached out to and pulled these different line items, just asked them some questions, say, hey, where are you sitting on 2022? People are very transparent with us on that information, with the idea that it's 100% confidential. And so this composite gives us a really good idea. You start throwing 100, 200,000 acres into a sheet like this, and you could pretty well narrow it down. So what we're looking at here to get started is a soybean side-by-side comparison. And this is 2022 on the left, 2023 on the right. When we did our projections here, where we're sitting at an average marketing price for the clients that we work with is about 14.12. Again, we're not marketers, we're not brokers, we don't provide marketing advice. This is just some perspective for people that we're working with on cost of production and how they're doing on marketing. Yield estimates dialed in at about 63.2. That's average. Of course, trend line generally increases year over year, which is why we have the updated yield estimate for 2023 over here at 64.2. I know this says 20 right here. It says 21 and 22, but it's 22 and 23. So what we're seeing last year, return to management, this is your cost of living, everything that you're pulling out of the farm operation. Generally speaking, about $84 an acre. We see that range anywhere from a negative number to where people have off-farm income that they're actually contributing back into the farm operation, all the way up to $200, $250, $300 an acre. Just depends on the operation. As a rule of thumb, if you listen to the headlines, 6.5%, 7% inflation, maybe that's the case. In reality, we've typically seen 12 to 17% as we start running through profit managers. Some people would argue higher than that. But what happens in these periods of high profitability, you make more money, you spend more money. That's not a problem. We're not being critical at all of how people do that. But, projects and paying things off, so on and so forth. So generally speaking, looking at about 6.5% increase on that. Land prices, again, average in here. This is between owned land and cash rent, 50-50, whatever share scenario you might have, up about 10%. We haven't seen any real major, real scary rent increases like we've seen in prior years of high productivity. Some of that probably has a lot to do with the increased input cost as well that have been associated with that over the last 18 months. Not saying that won't change, looking at about 10% there. Taxes, trend line, 2 to 3% up year over year. Interest has been a big one. So we've seen a lot of folks, a lot of farm operations did a really good job, took advantage of some of the low interest rates. We could kind of see the writing on the wall. Joe, you talked about this earlier, just on, how this interest rate has changed, as well as some of the inflationary costs. Right now we were just in the bank, did a note today at 5.5% interest. I think 18 months ago, we would have had the opportunity to do the same note at 2.8 or 3. Just the way things are, functionality of what we're seeing in the marketplace, generally speaking, up about 5%, maybe a little bit more in some areas. Insurance costs. This actually surprised me. I thought we were going to be a lot higher on this. This is looking at crop insurance, and in these areas of the higher insurance levels that we saw, not only for 2022 crop season, but when we evaluate for that for 2023, we're still looking at periods of high productivity, high income. Generally speaking, we're probably going to see that at a higher level than what we have in the past. So be sure to keep that in mind. Be having conversations with your crop insurance provider and ensure that you're looking at what levels of coverage you need to protect your crop. Maybe you don't want to overinsure, but also looking at things like margin protection. If you have that available in your area, not everybody does, might be something to consider there as we look at some of these price increases year over year. Seed up about 7.6%. For reference, what we saw from 2020 to 2021 2021 to 2022, we were looking at about 5% increase, probably a little bit higher than that. What we've seen in a lot of areas, just primarily due to the increased cost of production for that parent seed. At least that's what we're hearing here initially. Fertilizer up an additional 10%. So Joe, I might pick your brain on this as a little bit of a segue between the budget here on soybeans. Last year I went back and looked when folks were making pricing decisions as far as purchasing inputs from October of 2021 to March of 2022. D's 22 corn went from $5 to $6. Nov 22 soybeans went from $12.50 to $15.20. Or somewhere in that range within reason. Right now we're sitting at $5.59, kind of right in the middle of that for D's 23, and we're sitting at $12.58 for Nov 23 soybeans. So how do you think about that? You and I were talking the other day from a budgetary standpoint. Everybody has their own budget. Everybody has their own cash flow needs. For a farmer that's looking at these prices right now, and maybe moving into some of the input purchasing timeframes here over the next 3 months. Any thoughts on that? What are you asking the farmer when they call, or, you're talking to someone like me?
I don't know anything about 2023 aside from, the sort of stuff that you're showing me here. And I've seen similar, budgets and spreadsheets from different farms. And I have no clue or no indication of what prices of, 2023 fall delivery crops are going to do over the next 6 months or 12 months even. I mean, I don't know that.
Mhm.
All I know is that it looks like, again, your cost of production is going up here. I mean, total per acre expense going from 698 to 763 in beans. I mean, that's a big jump. So you need 1190 to break even. Is that what I'm seeing on your spreadsheet? And that's up from 1104 last year. I mean,
Right.
that's another big spike in cost of production. If these input costs are all realized, and I'd love to see some of this stuff come down along with, broader commodity markets and just things in general. But I mean, if you're going to make a sale, you have to do it. And this is like such a plain vanilla, boring answer, I know, but it's the only answer I know for it, is you got to do it because it's a business decision. It offsets a portion of your risk. It makes money. You know where you stand on at least a portion of the bushels. And then the amount probably depends. This is probably stuff that you guys do more than me, but the amount of bushels you're going to sell for 2023 delivery, if anything, probably depends on who you are, your financial situation. Do you have a ton of debt? Do you have a ton of leverage? Are you cash rich? Can you store everything? Can you not store anything? I mean, all of those things I think come into play, but if you're going to do it, it's got to just be a risk management business type decision. I have no prediction whatsoever about what's going to happen to these 2023 markets. We could be at $9 beans. We could be at $19 beans. So if you're going to do it, you have to look at it through that lens. It's just not me or anybody else out there has a clue. This is all just, budget management type stuff.
What you said there on the bushels, I really like that. Chris was recently on with Chip Flory on AgriTalk, and the focus of the discussion was looking at if you are making bookings or prepaying or looking at your expenses for 2023, knowing what they're going to be based off of, your numbers or numbers like this, whatever it is that you use. Like you said, Joe, there's a lot of different spreadsheets and tools and great systems out there. Is maybe, are you protecting yourself in some sort of way or making sales that correlate to that expense? And so that's one thing that we look at closely just when we're working with farm operations is, are you making sales that are adequate or equivalent to cover whatever amount of risk you need on that sale for 2023?
It's been surprising to me to this point, just kind of on a side note, just an opinion thing. I have not seen much hesitation from farmers to pull the trigger on 23, even though everybody who pulled the trigger early on 22, felt silly about it later because the prices went higher. But I think people, generally speaking, at least the people I deal with, they're comfortable with making some of these 23 decisions. I think they understand the risk. And I think that's where a tool like this really helps, is it helps you to understand a variety of different scenarios and understand the risk that you're dealing with. I mean, these high input costs just present a phenomenal amount of risk if the market were to go the wrong way on you. And maybe 23 is going to be a repeat of 22, and maybe we rally for another year straight, but maybe it's not. And maybe next year looks a heck of a lot different. And maybe next year is one of those years where forward marketing pays off. So you just don't know. And you've got to kind of put yourself in a position to withstand either scenario, I guess.
Mm-hmm. So we'll keep rolling here. Nitrogen on soybeans, typically 0 across the board. Herbicide, fungicide up about 7%, near as we can gather from retailers. Equipment cost up 9%. I wanted to hit on this one real quick. So John Deere, Case, and several other companies have actually already announced increases. Another one coming up here in the next quarter, and then possibly another one after that. So this would make, 3 increases over the last 18 months, whether it's to keep up with inflation, the supply chain and logistics issues. There's just a tremendous amount of increase in equipment costs that we're feeling directly at the farm operation level.
And that stuff, the problem with that stuff is that it doesn't come back down like grain prices can come back down. I mean, you can take 25, 30% off the price of corn or soybeans in the course of, 2 or 3 weeks, where stuff like that doesn't move like that,
Mm-hmm. Absolutely. So grain hauling, a lot of that expense is due to the increased fuel prices. We have seen fuel drop off here over the last several weeks. I can't even tell you. I heard it this morning, just how consistently, how many days in a row we've had fuel prices dropping. I don't have any pulse on that. I have no outlook on that from those that we work with in the trucking industry. A lot of the increased rates have been due to fuel, but also due to the amount of freight and the amount of hauling opportunities that are out there. Excuse me, we had a client of ours, would have been probably 2 months ago. He said the equivalent of what's going on right now in the trucking world, if you're running a commercial size trucking operation, would be the same as if you had a landowner come to you and say they wanted you to rent another 2,000 acres or 4,000 acres. I mean, there's just so much work and so much opportunity out there. Rates have correlated with that as well. So a lot of the trucking grain hauling increases have been due to that and the fuel prices. Tile and irrigation, we typically set that as a 0 when it comes to the budgets, just because not everybody runs irrigation and not everybody plans tile expenses. However, talking with a couple local tiling operations, looking at potentially another 15 to 20% increase as we look into next year, just on getting that in the ground. And again, the amount of work. I think it's important to remember, regardless of what the prices are doing and regardless of the opportunities that are out there, there's more money in the marketplace. There's more farmers that are making money and more farmers that are looking to spend money. So you compound that effect with limited services. Not everybody in the world wants to put in tile. These operations are in really high demand. They can and probably should be charging these higher rates that we're looking at. Probably to wrap up here, what I would say on the soybeans and what's most dramatic. So this tool, anybody that's listening, we'll send it to you. If you're watching the video here, shoot me an email, shay@agviewsolutions.com. The ROI that we saw or we're projecting, are currently projecting on soybeans for 2022, based on this average market price, we're somewhere around 28% ROI. Next year's projection bumps down to 5.9%, average 6%. That's more what I would call normal, pre-2020, pre-2019, with the alphabet soup that we had from the government, CFAP, MFP, WIP plus payments, things like that. 6%, again, that's with a yield increase, but this projected market price at $12.58. The beauty of this tool, and that I would encourage people to understand for their operation, is you can come in here and let's say, market price goes back up to $13. It's going to instantly update. It's going to change your numbers. You can change these assumptions. If land in your area is up 15%, go ahead and calculate that in based on your rents. If fertilizer is only up 6%, you can adjust that too. The importance here, as Joe was mentioning earlier, run your budgets, run your numbers, know what these are, and it should help you make some better decisions. So we'll hop over to corn here as well.
Gosh, that ROI number changes fast. I was looking at the old version of this from a couple of days ago that Chris sent me, and he had 13.37 punched in as the market price on beans, and your ROI was like 12.4%. So I mean, basically over the course of like 3 days since he sent me this thing, it got cut in half, or more.
Right. That sell-off that we saw.
Oh gosh, it happened so fast.
What's interesting too, and we'll see this in the summary, when you look at what the net income is, to your point, Joe, when Chris sent this over, 3 days ago, you and I were both looking at it. Beans actually had the advantage. When you come back in and change these numbers from the summary perspective, you put that 1258 back in there, all of a sudden soybeans are not carrying that advantage anymore. You're back looking at corn. I was just reading today online, someone out of StoneX was, looking at the potential of having tremendous amount of corn acres, 92 million or more than that next year as well. You start looking at numbers like this, I can see how that'll play out.
Yeah, if we can get those fertilizer costs back down to some extent, or just every issue associated with that would help a lot too.
We don't want to throw any wrenches in that though. I mean, we saw how easily those compounded over the last 2 years, pretty drastic. We'll breeze through corn here pretty quickly. We are looking currently at market price around 601. Just for reference for folks listening, this average is pretty well in line for everybody that we're working with. 48 to 52% sold on new crop here for 2022. For some people that are being affected by the drought conditions, there's some concern that they might actually be a little bit more than 50% sold. We'll see what the yield does. Hopefully those areas can get some relief in the form of rain. However, current market price, when we look at Dees of 2023, 559 right now. Those yield estimates, we increased by about 5 bushels. We had decreased this a little bit to 214 just based off of what we're seeing out of the drought right now. Your guess is as good as mine when it comes to this, Joe. I don't know. One point that I wanted to make here this evening, that as we get closer to the end of August, early September, whatever you're running for budgets, doesn't matter if you're running Profit Manager, any other number program out there, spreadsheets, budgets, go back in and put in an estimated yield number based on what you're seeing on the ground and in your fields. And the main reason for that is the number one way to impact your cost of production is that swing that we see in yields. So if it's dramatically lower, put that in. That way you know where you're at in your marketing plan. If it's dramatically higher or even just generally higher, that adds to things like your logistics. What are you going to need to do on trucking? Do you have additional bushels to market? How are you going to be handling that? So we always encourage everybody at a minimum, outside of running your projections at the beginning of the year, updating when you have all your final cost, do your yield. And then of course we do the remediation at the end of the year. So it's so important. August, September, get out there. Joe, I know you like living far away from the corn so that you don't have to drive by it every day and see how it looks and have the emotional impacts of the marketing. But we encourage people this time of year to get out there and do that.
Yeah, I get plenty of reports. Don't worry about it.
So the return to management, same. Land, same. We don't make any adjustments there on return to management, land, taxes, and interest. For crop insurance, we have that set at the same as well. Generally speaking, those corn and soybeans are on par. Same for seed. Nitrogen is the only one that you're going to look at that's going to be different here versus the soybeans. And we have this up at 15%. I think this makes for a really interesting discussion. Joe, you talked earlier about, hopefully we do see some fertilizer prices decreasing, especially as we see some of the commodity prices falling. But when I looked at that and looked at that $5 to $6 increase from October of 2021 to March of 2022, we're still right in the middle of that at 559. Nitrogen has dropped off pretty significantly to the tune of 20 to 40%. That's port delivery, not necessarily what you're seeing locally. People do still have concerns about what that physical product looks like. That's why I mentioned that about that, throwing the wrench into that. So any thoughts or any comments that you would say on the nitrogen side, fertilizer side? How closely do you follow some of that stuff, Joe?
I don't, probably not as closely as I should, but it was a big deal. I mean, this past year, I think that elevation in cost was like the sole reason that we didn't plant, 2 or 3 million more corn acres would be my assumption. So, I mean, it's a big deal in regard to acreage, which at the end of the day affects the markets a whole lot. So it definitely is a big deal. And it looks, based on what I'm seeing here, like it's going to be a big deal again for next year's crops too.
And no one knows what that supply is going to be like. Of course, I did find it interesting, Joe. I was talking with a seed customer of ours today, and he had made the comment on nitrogen, and I didn't really think that there was any supply issues. So he made the comment about this fall of, have you heard anything? Are we going to be able to get nitrogen? What are you hearing in the countryside? And I said, well, not really. Nobody has pricing out. That's with any of this stuff that I'll talk about here in a couple minutes. But I said, I really haven't heard anything, but also I'm a little hesitant on that just because we heard so much about that, last fall, but especially this spring. Are we going to be able to get physical product? Up until then, I didn't actually know anybody. And he goes, no, he said, I had booked at $700 a ton back in September of 2021. And they called me in March and said, hey, we can't do physical delivery of the product. We're going to need you to switch over to 32% instead of anhydrous. Ended up paying almost double, for that pricing. Wow. So the bookings, you talk about having a pretty dramatic impact on, your bottom line when it comes to that cost of production. If you're looking at 50 cents a bushel versus $1 a bushel, that adds up pretty darn quick on 200 bushel corn.
Oh yeah.
Okay. So again, no other additional costs here, maybe a little bit on storage, just depending on how these yields map out. But I would say ultimately, nothing too crazy here. Had a gentleman here say, book some anhydrous this fall for 870. So maybe we are looking at some areas that are a little bit more normal. I think a lot of that depends on the quantity that you're able to map out to. What do you have for on-farm storage? I think with this input pricing and the early prepay, things like that, how does that make a difference in what your physical holding capacity is? We had a lot of operations over the last 12 months put in a lot of additional storage just so they hopefully never have to deal with some of the supply chain issues like we have over the last year either. Okay, so ultimately moving over here on the budget to the comparison, everything that you enter, everything that you adjust on this corn and soybeans pulls back over to the summary. This is what I think is the most interesting and maybe the most profound when you make these changes. So on a 2,000 acre operation, 1,000 acres corn, 1,000 acres soybeans, what we're seeing from 2022 to 2023 on that 2,000 acres is an additional $175,000 of working capital demand increase year over year. When you look at this from 2021 to 2022, that was about an extra $150,000 for most operations. So potentially looking at more of an increase even than we saw from 21 to 22. Looking at that same number, maybe a little less, maybe a little bit more for 2023. Joe, these are all based off of, estimates too that we get from farm operations. There's nothing scientific about our data collection that we have here. Our goal is just to always provide kind of that value and perspective, what we're seeing across the countryside. But
yeah, that's compound interest right there. It's great when it works for you, but it's not so great when it works against you.
Right. And who knows what we're going to see on this prices as well. Nice part about this too, for what it's worth, like I said, we can send this to anybody. It's just a free tool. Hopefully it helps people make some decisions. Looking at what that cost of production is on a per acre basis, or per bushel basis, and tied against that assumption for what your price outlook estimate is. Again, at this time, based on the numbers that we're looking at here today, that was at the close today, 1258 on soybeans, 559 on corn, something to keep a close eye on. What I think is really interesting, these 6% levels ROI, 2017, 2018, 2019, a lot of those numbers looked really good. If you were pulling 6% ROI, are we back to that time period? I don't know. Maybe depends on how aggressive you've been on 2023 marketing and what your plan is as you move forward too.
Could you imagine if it was about this time 2 years ago and you were to look in the future and see this when corn was like $3.50, like right after COVID? I mean, it's absolutely phenomenal, the shift that we've seen just in the last 2 years in everything in the entire world. And this is obviously no exception.
It's better to be lucky than good. I've shared this with many people, but when my wife and I decided to start financially farming a couple of years ago, we had an opportunity to get in on that. We made that decision when corn was at $3.30 and beans were low $9, and we're double or 50% that right now. And not by any means of our own, just, we've made bad marketing decisions as anybody else has over time, but this is scary to a lot of people. This working capital increase is scary.
Oh yeah, it's terrifying.
And not only from a budget outlook and a marketing standpoint, I think it's more important than ever to make sure that you know what these numbers are, have them dialed in, and have that communication, that plan in place. When you call someone like Joe or whoever you're working with on the marketing side, make sure that you have these numbers in front of you, know what it looks like for your farm operation so that you can make better decisions on that and have kind of a key outlook. The other person to keep in mind or really keep in the loop on this conversation is your lender. Right now, we're looking at a lot of estimates as you start getting in prepay, whether it's anhydrous, herbicides, fertilizer over the next 2, 3, 4 months. Make sure that you're staying in close contact with them. Most operations did not have an issue going to their lender asking for additional funds last year if they needed that, if they weren't operating on a cash basis. I don't think it's going to be any different this year. There's going to be a lot of farm operations that are going to need a little bit more cash to operate. Still looking at good margin out there, still profit opportunities on the table. Don't be afraid to, take advantage of that. One thing that I would say with this market volatility, Joe, Chris and I were talking about this a little bit offline earlier. When it comes to maybe marketing strategies, or if some of this stuff can be so overwhelming for farmers, one thing is setting targets or saying, okay, here's what my numbers are. Here's maybe what my projected ROI or my target margin is. how do you feel about setting targets in the marketplace? Is it a good tool to use? Strategies? How do you think about that when you're working with farm operation?
This early in the game for 2023, I think, I think doing something is better than doing nothing, just because of what you're showing me in regard to working capital and how high the cost of production is, and all those things. How you do it, so as long as you get yourself into a situation where you can withstand some lower prices. I don't care if it's through a target order that accomplishes some margin target, or maybe you just open up your sheet and you look at the board tomorrow and you say, you know what, this makes money, and I'm going to offset some of my input costs and just make a sale because of that. It doesn't necessarily need to be a target. So I don't have any opposition to setting target orders above the market. If you see something on a chart or something really clicks for you in terms of ROI or budgets or whatever. But I don't think it necessarily matters how you accomplish offsetting that risk in terms of the sale, like what your method is. But doing something, or at least taking a look at it. Maybe you're somebody who can afford to not do something here, but I don't think there's that many people in that camp right now.
Mm-hmm. When we look at 2023, I'd say generally speaking, some operations anywhere from 0% to 25%, 10 to 15% sold catches the average. Is that fair, or does that seem in line?
I'd say that's probably pretty fair. I know people that are 0. I know people that are up to 25 or 30 even. And again, like I said earlier, just a lot of it depends on who you are, financial situation, all of those things. Some people are extremely risk tolerant. Some people are risk takers. Some people aren't. I would say that the last year and a half probably favored the risk takers, because if you were more of a risk manager, you made the early sales, and you would have been better off, of course, in hindsight, to wait. But we can't know if that's the right move for 23 right now.
Mm-hmm. The reason I brought that up on targets too, it's a busy time of year. People are taking vacations, hanging out with family.
Yeah.
Getting stuff prepped and ready to go. A lot of times, some of the opportunities that exist are when we're busiest or not paying attention. So, we were just talking about that. Just thought we'd pick your brain on that a little bit.
Yeah, I don't have any real strong preference in terms of how you do it. If setting a target order and forgetting about it is the best way for you, then that's fine. If just being a little bit more active and watching closer is better for you, that's fine too. I just think you got to be paying attention here.
Mm-hmm. Joe, anything else we didn't hit on? Anything else that you want to see out of the budget tool? Of course, we can't compare crops side by side too. I think this is going to be really important. Looking at corn and soybean side by side, you push in your 2023 numbers here, what those projections are. Again, you're making the assumptions. We're not telling you what to put in here. But anything we haven't covered, or anything that you'd like to share before we sign off here?
No, I tend to be kind of a numbers person. I just see a ton of risk here is what I see. I see a astronomical cost of production. Prices that it takes to break even are prices that would historically be considered to be very high in the corn market or in the soybean market. And that leads you to the question, have we really reached a new plateau in terms of corn and soybean prices, or is this a temporary deal that lasts 2 or 3 years? Those are all questions that we can't know the answer to. But this input cost thing, and just the fact that we continue to see these like double-digit increases percentage wise in terms of cost of production, it's scary stuff, guys.
Mm-hmm. Joe, thank you so much for taking the time. If anybody wants to reach out to you or subscribe to your podcast, anything like that, what's the best way for them to get a hold of you?
Yeah, just check out the podcast or the YouTube channel. It's called Grain Markets and Other Stuff. There's a new episode every business day, very early in the morning. Check that deal out. I'll be on again tomorrow morning.
Perfect. All right. Well, thanks. And thank you, everybody that's able to hop on here tonight. Hope you guys have a good evening. Feel free to reach out to myself or Chris or Joe anytime. Again, our phone numbers are here on the screen. And then my email is shay@agviewsolutions.com. Hope everyone has a good night. Thanks a lot, Joe. Really appreciate it.
Thanks, Shay.